So the Marines have a great slogan, and if you've ever watched television for more than 60 seconds before you've heard the commercial, the few, the proud, the Marines! I absolutely love that, by the way. And the stock market has a very similar slogan right now. It goes something like, the few, the stocks, everything else crashes, and that's exactly what is going on in this market. Public count, new all-time high today, $2.355 million. Why? Well, the very few are doing great. Nvidia, Palantir, Meta, Tesla, Amazon, the same stocks that seem to go up day after day and push the market higher and higher, just go up and up and up. Meanwhile, beneath that layer, it is complete devastation. Nike stock now down 33.33% year to date. SoFi stock down 33.88% year to date. Wynn Resorts just hit a 52-week low. Celsius Beverage is down over 30% in the past 3 months. They're trying to save it. Oh, we're maintaining our buy rating, our neutral rating, but they can't save it right now, right? Lululemon stock, so brutal. Nearly 44 percentage points down year to date. Unbelievable. Estee Lauder. Oh, say it louder. It's beyond brutal. This stock's down 44% plus now on a 5-year. Keep this in mind, this stock was $370 a share less than 3 years ago. You gotta be flipping my flapjacks. It might break $100 very soon. Buc-ee's, Starbucks is now down about 14% in the past 5 years. Unbelievable. I mean, unbelievable. It's literally right now, it's at 5-year lows other than during the Rona crash. Incredible. Fubo, one of the biggest streaming television companies out there, down 61% year to date. McDonald's, down about 16 percentage points year to date. Oh, you got to be flipping my flapjack. Johnson & Johnson has had a multi-year slide, usually seen as one of the best, safest, greatest stocks in the market. This one's up only 5%. It's clinging on to a 5% gain in the past 5 years. That's how bad it's gotten at Johnson & Johnson, right? 3M, this is another company that is seen as a rock in the market, right? These supposed to be super stable, great companies. This one's down 31% in the past 5 years. Disney's down 31% in the past 5 years. Another rock. Verizon, how about another rock? Down 28% in the past 5 years. Boeing, another rock. And by the way, they deserve it. 28% down year to date. The moral of the story is this is the most strange stock market I've seen in my 15 years of being in this game. I can tell you that much. And if you go throughout history, this is one of the most strange stock markets you'll ever find in all of history, right? We got a market at all-time highs, yet outside of really the top 10% of stocks, it's an unnoticed crash that no one's really talking about. There's an actual stock market crash going on when the stock market's at all-time highs and no one even notices this is going on right now, right? And I'm going to try to make sense of this whole situation in this video and kind of tell you what the next play is. What's going to actually happen from here? How's this situation going to correct itself? Because it will correct itself. I promise you that. And we'll talk about the two scenarios on how this could actually play out. I appreciate y'all joining me as always. Thank you so much for being here. I hope you guys enjoyed that intro there. New all-time high subscribers in the history of the channel. I appreciate each and every one of you. Are you subscribed to the channel? If you're not, why haven't you hit the subscribe button? Come on, man. We got a new profile picture. There it is, baby. Serious business, baby. So where we want to start out this video here today is market all-time highs, yet the outside of the 10% is in a crash, right? Well, what if we looked at income earners and we really thought about this a little deeper, right? Check this out. I think this matters significantly. If we thought about the top income bracket, right, in the United States, it's the $200,000 and over bracket, right? And around 12% roughly of the population makes $200,000 or more. Now, for the folks out there that make over $200,000 a year, things are honestly better than ever. And why are things better than ever? Well, the jobs are there, right? The wages are there. You're not as affected by inflation. Like if you make $700,000 a year, you're not going to be hit nearly as much by inflation as somebody that makes, $70,000 a year, right? That gallon of milk and a gallon of gas and, interest rates and all those things, they just matter a lot more to you the less money you have, right? And so things are better than ever. Stocks are at all-time highs, as we looked at, right? So if you just own the S&P 500, you own just the biggest stocks, like you think things are great, right? Real estate's near all-time highs right now, right? And simultaneously, you're able to get 4 to 5% on either treasuries or high-yield savings accounts. So if you're a top, 10 to 15% income earner, things are better than ever for you. Now, if you go beneath that, right, if you talk about, let's call it the income earners that are kind of under $200,000 but more than $100,000, I think for those folks, things are kind of feeling a little meh out there. And then the rest of folks, which is the far majority of individuals, things feel very bad, right? Which makes sense. Look at consumer confidence numbers, look at consumer sentiment numbers. They're absolutely horrible, right? And unless you're somebody that lives, well below your means, you feel like pretty bad about the state of the economy, about the state of money in general, about your state of your finances, right? And let's be honest, this is America. And in America, people live beyond their means, okay? Or at least at their means. Very few people live below their means. Some of you guys watching this video right now, you guys live below your means, right? But I can just promise you, this is America. And in America, people don't usually live below your means. If you live below your means, you're the minority. And so if you are living in a household that makes under $100,000, the only way you feel good is if you live under your means. But that's such a small percentage. So the far majority of folks are not going to feel good in this situation, right? Which then takes us, if we, basically said, okay, this wasn't a chart about income, this was just a chart about the strongest companies with the strongest workforces and the very strongest products and services. Guess what, right? Things are better than ever for you. If you're that top 10 to 15% of companies, things have never been better for you, right? You're making a ton of interest income because you're able to take all your massive cash loads of billions, tens of billions, or hundreds of billions of dollars, have treasuries earn you crazy money right now, right? You're able to keep your workforce in check. Your revenue's likely looking pretty good. Your net income's likely looking pretty good right now, right? And so for the top 10 to 15% of companies, this is the best it's ever been for them. They're so happy, right? And then you go below that, right? And then those companies are kind of like, things are okay out there. And it's not like that good. It's like, meh, right? And then you go below that, and a lot of other companies are saying, no, this is not a good situation. It's very ugly, right? And we could even break it down like this, right? If you're a company and you cater to six-figure income earners, your numbers have been pretty good for the most part, right? For the far majority of those companies, things have been good. But the problem is most people don't make six figures a year. And so for the majority of these large companies, they're counting on the average person, right, the middle class and below, to be buying their products and services. And so therefore, if you're counting on that, you're in a tough spot right now. You're in a very, very, very tough spot. We can even see this in something like housing, right? If I pull up my housing stocks watch list, I can show you exactly what's playing out here, right? Look at somebody like a Toll Brothers. What do we know about Toll Brothers? Toll Brothers caters to the top 10 to 15% of income earners. That's who the majority of their customer base is, people that make really good money, right? Toll Brothers, the average selling price of a Toll Brothers home has now climbed, if I recall, over $1 million. Average selling price, right? Average. So they're counting on those top 10 to 15% of income earners, right? And guess what? Their stock is phenomenal. That stock price is up 47% in the past year. By the way, that won't last. But for now, it's great for Toll Brothers, right? Meanwhile, look at somebody like Enphase Energy. And guess what? Enphase is not just counting on the top tier. They're counting on the everyday man, right? That stock's down about 36, 37% in the past year, right? Solar, sure, do some top 10, 15% income earners get it? Yeah, sure. But also a lot of people that are tighter on budgets also like to get solar, right? And the reason being is, that electric bill matters significantly to you. And so you might be looking to save some money. But the guy that might make $60,000 a year just can't afford solar really right now. It's unrealistic. And with loans and interest rates where they're at, it's certainly weighing on somebody like an Enphase Energy, right? Look at somebody like a Whirlpool. Whirlpool counts in the everyday man, right? They're not selling the highest end refrigerators and dishwashers and washers and dryers and ovens and those sorts of things, right? Whirlpool's counting on the everyday man. They sell at Home Depot. They sell at Lowe's, right? They sell at Best Buy. And so they're counting on the everyday man. Stock's down over 30 percentage points so far in the past year, right? And that's even after the recent rise that the talk is they might get bought out, and yet that stock's still down 30+% in the past year, right? Now, what's interesting is even somebody that like an RH that really caters to the high income earners, they're even getting squeezed. And the reason being is the furniture market is so tough right now, right? RH down 27% in the past year. The furniture market is so tough that there's pressure from every level that then puts pressure on the very top, which the very top is RH. But if every level below RH is discounting and doing deals and, you know, this deal and that deal and this deal and that deal, because at the end of the day, we're in a tougher furniture environment, right? So the couches and the sectionals and the dining sets are all on discount, the bedroom sets, right? If all those below tiers are all putting pressure on each other, then it eventually starts to actually affect even somebody like an RH. And that's why if you look at somebody like an RH's numbers, they're not good. Even though that's a company that caters to the highest end, because they're getting squeezed, because people are saying, going a tier below them and saying, you know what, this price is so below RH, I'm just going to go with this tier, right? And so you're even seeing a squeeze in some of those sorts of companies, which is really intriguing. You're even seeing in things like banking, right? Look at Goldman Sachs. Goldman Sachs, I mean, everybody knows Goldman Sachs caters to high net worth, right? We all know that. That's no secret. Goldman Sachs this stock's up 50% in the past year. It's very rare you're going to find Goldman Sachs climbing 50% in the past year. And keep in mind, investment banking's horrible right now. In really like IPO market, which Goldman Sachs usually makes a bunch of money off IPOs, dude, that market's dead. It has been dead. The IPO market died back in 2022, and it's been dead in 2023 and 2024. The IPO market might come back in 2025, 2026, but it is dead right now, completely dead, right? And so Goldman Sachs is not even benefiting from that. Yet, the company's doing great. It's doing better than ever, and the stock price is doing better than ever. The stock's literally at all-time highs right now, right? Yet, you go a little below that. You go to somebody like a SoFi, right? Might go a lot below that. SoFi counts on, who's a lot of SoFi's customer base? Gen Z, millennials, right? Not exactly the people that have the most money in the world. And SoFi stock down 19% in the past year, right? You know, that stock just seems like it can't do anything right. $6.54. And Goldman Sachs is like, oh, we're at all-time highs. Look at JP Morgan. JP Morgan, huge with the baby boomer generation, huge with, a lot of folks that have a lot of money. Let's just call it that. JP Morgan's got a very successful private client business, which is really people that have let's call it around a $1 million net worth or higher, right? And then they have a very successful private bank business, which is really for people that have over a $10 million net worth. JP Morgan stock up 43% in the past year. The stock's at all-time highs. It could not be better for JP Morgan. And why? Because things couldn't be better for that top 10 to 15% of the wealthy and the income earners, right? Meanwhile, look at a firm. A firm, guess what? Top income earners don't use a firm. No. Buy now, pay later, no. Okay. People that are using buy now, pay later are usually those folks I was talking about that are living beyond their means and are very tight on money and likely don't have the money, right? Somebody that makes $350,000 a year should not be using a firm and aren't using a firm, right? So a firm is down about 42% so far this year, right? That stock is just getting destroyed, absolutely wrecked and obliterated. Day in and day out, it seems like, for that stock. And it just goes lower and lower. And you look at a stock like that and it's like, where's the bottom? Because it's not showing, a firm stock is not showing any signs of bottoming, right? And that's the scariest thing with a stock like that. It's down 42% this year and it's like, where's the bottom? We don't see it yet, right? Look at a stock like Chewy. This is another company that really counts on everyone, right? Everyone should be Chewy's customer base, 31% down in the past year. And I don't know if you guys have heard some of the stories, but a lot of the animal shelters have filled up over the past 6 to 12 months. Stories coming out of Arizona. I'm hearing stories here in Vegas, like they're waiving fees to adopt animals. Have you guys heard about this? Let me know in the comment section if you've heard of this. Like, you're really on the up and up if you've heard some stuff like this. Okay, but basically these places that take in animals, they're overflowing with animals right now, and the reason being is a lot of folks just have had to cut back, and they literally can't afford to buy their pets, new toys and treats and just even necessities like food, sadly enough, right? And so they have to give up their pets to the shelters, and these places are overwhelmed with the amount of animals, right? It's a crazy situation. And so at the end of the day, that affects even somebody like a Chewy in a very, very substantial way. I mean, at the end of the day, if people can't even afford to buy their dog food, they're not going to be buying their dog toys. Like, just common sense, right? And so that hurts somebody like a Chewy in a substantial way, right? eBay, look at this stock, 22% up in the past year. Well, why? Well, think about this on a little deeper level, right? If you're in tougher times, people look for deals. They look to buy used stuff, right? And guess what? eBay is a perfect play on that, right? And so somebody like an eBay could actually be benefiting in this environment because in a good economy, somebody might say, you know what, I need a new DSLR camera. I'm just going to buy a new one from Best Buy, right? Or they can say, you know what, I need a new DSLR camera. Let me look on eBay. Let me buy somebody that's selling theirs because I could probably get a $200 discount on that or a $300 discount versus buying brand new, right? And so they go on somewhere like an eBay to look for a deal like that, right? And by the way, eBay's always had some actually really good deals on new products as well when it comes to some different electronics. So just something to kind of keep in mind there. And something like an eBay definitely benefits in that sort of time, right? eBay's, I don't want to, this might sound bad, but it's almost like a pawn shop, but for the internet, right? Just a very big, glorious one, right? And then you even look at something like this. I posted this yesterday inside the private group. What I posted here, this is a Target chart versus Walmart. And I said, interesting to see a 10-year chart of Target versus Walmart. Target was killing Walmart in a stronger economy from 2014 to 2021, which we can definitely say for those years, we're definitely in a stronger economy. There's no doubt about it, right? Where the unemployment rate just seemed to drop other than the little blip there in 2020, right? And it just seemed like we were in a really strong economy overall, right? 2022 through 2024, in a tougher economy, Walmart came back strong and has now taken lead. If we see in unemployment, it's not supposed to say in employment, it's supposed to say unemployment cycle, Walmart will likely keep the lead going. When the economy does get strong again, true low inflation plus low unemployment plus strong real wages, don't be surprised if Target comes back. When people feel weak economically, they're likely to gravitate toward Walmart for obvious reasons. When I was on food stamps in 2009, guess where I spent my $16 each month? Walmart TV dinner section, baby. As my net worth built, 2011, 2012, 2013, my wife and I slowly stopped going to Walmart as much and started to go to Target much more. From 2008 to 2010, I basically never went to Target. It was Walmart only. If you want to know how the economy is actually doing, screw government numbers, pay attention to Target if Target is outperforming Walmart or not. Kidding, not kidding. And it's actually, it's kind of like a joke, but it's actually being serious. Because at the end of the day, when the economy's in tougher times because Walmart's going to outperform Target significantly. It's exactly what we've seen play out. As soon as the economy started to get hit and as soon as people started to really get hit by inflation, right, and it felt like things had kind of peaked in the economy, which was in 2021, look what started happening in Target stock. It fell off a cliff, right? And look what happened to Walmart. Walmart hadn't really been doing much for years. It's been just kind of like drifting up a little bit here and there. And then look at this move in 2022 through basically right now. It's for Walmart, folks, that's a parabolic move. That's a parabolic move that Walmart's made in the past 2 years in regards to their stock price. And keep in mind, the longer the economy is in a tougher place, the longer Walmart will outperform Target, right? And eventually that will change. But for now, that's the situation, right? And you even look at something like Bitcoin. Bitcoin's an every man asset. There's a lot of wealthy folks that will not touch Bitcoin. Let's just be honest, right? A lot of people in their 50s, 60s, 70s that are like, nah, I'm good on that, right? But there's a lot of younger folks that love Bitcoin, right? And even an asset like that has started to fall 17% down just in the past month. And what's strange about this move down in Bitcoin here, and I know some people will blame it on the Mt. Gox situation and whatnot, right? What's strange about this is the Nasdaq's doing very well. And so to see Bitcoin down 17% in the past month, it's something bigger going on there, in my opinion, right? You look at something like Unity Software, stock's down 61% in the past year, right? But why? Well, even a lot of video game companies are not as excited to build new games because people don't really have a lot of the funds. What are video games counting on? They're counting on the everyday man. They're counting on kids spending a lot of money, right? And if you're in a tougher economy, that stuff's not as strong. Now, it's hard to even see a lot of video game numbers because a lot of these companies have been bought out the past few years. My King Digital, I used to own them a long, long time ago. They got bought out by Activision Blizzard. Activision Blizzard ended up getting bought out by Microsoft, and Microsoft just kind of like throws it in their numbers. You can't really see very much detail around that, so we don't actually know what's going on with Activision Blizzard's numbers. Zynga got bought out, so there's not even a lot of public companies you can unfortunately take a look at to really see what's going on in their business. Take-Two and EA are one of the few. And I looked at EA Sports, which kind of has a monopoly in their market, right? Look at this. Their revenues recently was down about $100 million on a year-over-year basis. Not good, right? Not good. And you can't blame it anymore on, well, there was the Rona shutdowns and, that was kind of a boost. No, we're talking about 2023 versus 2024. That's long gone at this point in time. And yet EA's revenue's down about $100 million on a year-over-year basis. Not good. And so it's clear as day, right, what's going on in the market. It's clear as day who's being negatively affected by what's transpired over the past couple of years and who's being positively affected by what's transpired in the past few years. And the bad thing for a lot of these big companies is they count on more than just the top 10 to 15% of income earners. They're counting on everybody. Everybody's Starbucks' customer. Everybody is McDonald's customers. Everybody is Nike's customers, right? And so when you're in that sort of situation, everybody's EA Sports customers. That leaves you in a tough environment for your stock and for your company here in the short term, right? Now, how does this story end, right? I see there being two potential ends to this story in the end, right? One is a scenario where the top of the market breaks in the next 3 to 6 months and the whole market has a major flush down, okay? And so what would have to happen when I say the top of the market? I'm talking these sorts of companies. So let's imagine a scenario where, I don't know, let's say these companies all have really good earnings coming out here, let's say this quarter, and their stocks just fly to another level, right? Let's say Meta hits a 600 plus, and Nvidia goes to 150 plus, and Google flies, Tesla goes to 300 plus, Amazon's 250, right? 225, something like that. Apple goes to new all-time highs, 250, something like that after their earnings. Microsoft goes to a new all-time high. Let's say we got some sort of really like blow off top, but then those companies start to kind of weaken maybe their numbers in Q4, and maybe we're in a situation where these companies report their end of October, beginning of November numbers are not quite as strong, right? And so all of a sudden you get those stocks to peak around November, which is similar to what happened in 2021 because guess what? All these stocks pretty much peaked in around November 2021, right? And so you could get a scenario like that to play out, and then that would just topple kind of the whole market at that point in time. You'd see a big fall in the S&P 500, a big fall in the NASDAQ after kind of a blow off top situation, right? And, keep in mind these consumer stocks that I ran you through at the top of this video that have already been hit and already look like great deals. Basically, those stocks will start to get to silly pricing, okay? Now, a lot of these consumer-related companies I ran you through at the top of this video, they're steal deals right now. But a lot of them haven't reached a shock and awe price yet, okay? A shock and awe price is when you look at a stock and you can't even believe it's trading down there. There's a difference between a shock and awe price where you're like, I can't even believe this stock is at that price versus like, oh my gosh, this stock is easy money. Like this is a steal deal. Like this stock, I can't believe it's trading down here. Like this is a great price for me to buy shares of, right? There's a difference between those two things. And we haven't quite reached shock and awe. Shock and awe would be Nike in the 50s, where it's like, no way. I look at Nike at 71 and I say, this is a steal deal. If Nike was 51, it'd be shock and awe to me. I look at Starbucks at the price it's trading at right now and I say, gosh, man, like people are going to make a lot of money on the stock over the next few years. Like they're getting a great pricing on this stock. If Starbucks stock fell another 15, 20%, that would be shock and awe. I'd be like, I can't even believe Starbucks is trading at these prices. Estee Lauder recently, great deal on that stock. If that stock breaks 100 and goes to $90, $85, $75, that's a shock and awe. I'd be like, what? Estee Lauder's trading at these sorts of prices, right? And keep in mind, that's what happened in 2022 with tech stocks. We saw shock and awe, where these companies went to pricing that you couldn't even imagine, right? NVIDIA stock fell over 50%. AMD stock fell like, oh gosh, AMD was down to like, what did AMD fall to in that crash? I think AMD fell to the 50s. Didn't AMD stock fall to the 50s in the 2022 crash, right? Meta fell to $88. Shopify fell to like 20 something dollars. Netflix stock fell to like $170, $180 a share. You just go through stock by stock by stock in that crash, and it was shock and awe everywhere. Where I looked out there and it was like, I can't believe this stock is at this price. I can't believe this stock is at this price. I can't believe this. It was pure shock and awe. And you saw countless of the greatest tech companies in the world down 30, 40, 50, 60, 70, 80%, right? A Shopify peak to trough was like an 80% fall. It was crazy, right? NVIDIA, like all these stocks, it was insane. And now these stocks are, by the way, the leaders of the market and they're seen as invincible. But I can tell you back in 2022, no one, other than myself and maybe a few of you guys watching this, wanted a piece of those stocks, right? It was incredible. And, by the time we got halfway through the year, by the time we were around this time in 2022, those stocks already looked like a steal deal. They already were at like, wow, I can't believe these stocks are trading at this price, right? But then we got another leg lower in them. And that was like crazy, right? And so that's a scenario that could play out here. Now, the second scenario that I could see playing out here is the top stays fine. Now, when I say fine, it means the top of the market stays in kind of a, if there is any downward move, it kind of is in the 5 to 10% range, okay? And so there's no like major like 15, 20, 25% move down for the top of the market. So the top stays fine, but in the 90%, so the rest of the market essentially starts to come back in Q4 2024 and into 2025. Now, in order to get this, you honestly need the market, you need the economy to get better, you need inflation to get better, and you need the Fed to start lowering rates. So you need a lot of things to play out to get this scenario. I will say that, okay? But it is a scenario that could definitely play out. And the 90% starts to come back. And so you see all these stocks that we ran through at the beginning of this video, a lot of these weaker stocks start to perform better. You see the Russell 2000 start to perform a lot better, and these stocks kind of play catch up, right? Now, if I had to put odds on it, I would say it's about a 50-50 on which one of these scenarios plays out. I mean, if you really put me down to it, I would say there's probably, maybe I'd go 60-40. Maybe I would go 60-40 on like a 60% chance this happens versus a 40% chance that happens. I do think it's close to a 50-50 though, but it's kind of a coin flip situation, right? And I could see this playing out. If we get a blow off top in these big tech stocks, these really ones that have really outperformed, I could see potentially, we top in either this quarter or next quarter, and then we actually have a major flush in those consumer stocks. Like the whole market just gets hit and those consumer stocks just go to levels that, and maybe also I'm a little biased. Maybe I secretly want that a little bit, right? So that is something to kind of keep in mind there because, geez, I already look at so many stocks, so many have such great deals, and I'm like, oh, if I get them even lower, oh gosh, whew. You're really attracting people. Here's the thing. You're at silly pricing on stocks when people that are not usually interested in those stocks start buying them. So for instance, in 2022, you saw people start to buy tech stocks that aren't even really traditional tech investors. Like even like value investors started to buy tech stocks because the pricing got to such ridiculously silly levels, right? When you start to see growth investors, tech investors, when you start to see them start to buy Nike, Starbucks, McDonald's, these sorts of stocks, Estee Lauder, these other ones, you'll know we've reached absolutely silly pricing. It's already happening, by the way. But I'm just talking about if you see another level of that, that's when you'll know you're at absolutely ridiculous pricing. When people that don't even usually buy those stocks start to buy them and say, like, dude, I can't resist. Like, come on, you're going to give me this stock at this price? Like, it's easy money. Like, I'll just take it, right? And so keep that in mind as well. And you got to take advantage of every opportunity in this market. What we're going through right now and what we're probably going to continue to go through over the next few months, this is 2022, but the difference is this is for consumer stocks, okay? It's for a lot of these consumer-related companies that are really counting on the masses. That's the opportunity you're getting. It's just not the tech stocks this time around, okay? So hope you guys enjoyed today's video. I appreciate you joining me. If you enjoyed today's video, you're going to enjoy my private group a whole lot more. You get access to all my best courses on building your wealth, on identifying opportunities in the market, figuring out which stocks are great deals versus which ones are a ripoff, all that good stuff, access to my 6 to 7 figure Discord chat, access to see the moves I'm making each week in my $2 million plus Fidelity account. If you want access to all that, apply with the pinned comment down there, fill out a form. We'll see if we can get you in there. We'll see if you're a good fit. Much love and have a great day.